You've probably heard this line before. Buy a property, hold it, and you'll be rich one day. But here's the truth. The rich don't play the same game you're playing. They buy properties to save on taxes and not to get rich. They already have strong cash flow from businesses, shares, and other assets. So, while you're bleeding money every month trying to build your wealth, they're using property to protect what they already have. In this video, I'll explain why negative gearing is a trap for most people, why it's not how the rich actually build wealth, and how you can play a smarter game to get ahead.
The reason the poor and middle class struggle is they buy liabilities they think are assets. Let me give you an example. You ask the average person, a house is an asset. Your house is a liability.
Because it's not producing any income.
Correct. It's taking money.
Hi everyone, before we continue the video, starting on November 28 to December 25, in the spirit of Christmas, we'll be giving away $80 a day. Yes, that's right. You see, the reason why we're doing this is because I know that everyone's struggling because of cost of living, housing market, or any other circumstances that's happening in your life. Now, I've been blessed all throughout the years. Have a good family, doing well in life, and I'm currently in the position to give back to my community. Believe it or not, I actually started as a student migrant here in Australia, which is why it's important for you to understand that when I was broke, I always hoped that someone would be able to help me in any shape or form, which actually happened a bunch of times. I have a lot of friends who helped me through hard times, which is what motivated me to do this giveaway. For you to qualify, all you need to do is subscribe to my YouTube channel, comment down below the hidden word which will be revealed later on in this video, and send me an email to show that you're subscribed to my channel to this email address. Let's start simple. What is negative gearing? It's when your investment property costs more to own than what it makes in rent. You lose money each week, but you get to claim that loss as a tax deduction. It sounds smart, right? You lose money now, save up on taxes, and hope that the property value increases later. But here's the problem. You're still losing money. You're relying on your full-time job to cover the difference. And if the market goes flat or the interest rate increases, then the cost just keeps getting bigger.
Negative gearing allows investors to deduct losses from their taxable income when they exceed what they get back from renting the property out. Treasury is looking at options to abolish or limit negative gearing and the capital gains tax discount for property investors.
It would take some heat out of the market given investors make up about 38% of housing finance. A lot of investors utilise negative gearing strategies. It may lead to some sell-off in investment properties, which would also bring prices down.
The rich don't want to lose money on purpose. They play to win every month, not just for 20 years later. So, why do people still do it? Because we've been sold this lie for decades, that real wealth is built through property. That's only half true, but only for people who already have a strong cash flow. You see, the rich invests in businesses, stocks, and other income-making assets before they buy properties. They use those profits to buy high-quality profits that have good cash flow, steady capital growth, and strong deductions through depreciation. That's the key. They don't buy properties that lose them money every week. They buy ones that at least break even or make a little bit of profit. Then use depreciation to reduce their taxable income, not to cover losses. Now, here's what most people don't realize. Negative gearing doesn't make you rich. It only delays the pain. When you buy a property solely for negative gearing, you're actually hoping that the property will go up in value to cover up all the initial costs that you've spent for your property. And that, my friend, is gambling. And the game is stacked against you because you're paying interest rates, insurance, and repairs and maintenance. Let's say you lose $200 a week. That's over $10,000 a year based on my quick maths. And what's your reward for that? Maybe a $3,000 tax refund. that means you're still losing $7,000 a year. And who in their right mind would call that investment? The truth is, the rich don't use negative gearing to get rich. They use it to manage their income tax. When you're already earning millions from your business, you look for legal ways to reduce your taxable income. And that's when property makes sense, because you can offset income using depreciation and interest expenses. But for everyday Aussies who are just trying to get ahead on a normal income, negative gearing usually just makes you cash poor. It locks up your money, adds stress, and limits your ability to invest anywhere else. So, what do the rich do differently? They focus on cash flow first. They build systems that create income while they're sleeping. This might be through businesses, dividend stocks, index funds like S&P 500 and ASX 200. Once that income is stable, that's when they look at properties, not as a moneymaker, but as a tax tool. And when the property grows, which it normally does, that's just a bonus for them. They buy properties that cover all their expenses through rent, sit in strong growth areas or locations, and can be legally depreciated for tax benefits. Their properties almost always end up break-even or slightly positively geared, because no smart investors want to buy something that loses money. Alright everyone, here's a short break. As promised, the hidden word for this video is blessed. So make sure to comment, subscribe, and send me an email to this email address. And I hope that this giveaway will help you out in any way possible. Merry Christmas, everyone! Let's talk about why people fall for this property myth. It's emotional. You can see it, touch it, and live in it. It feels safe, unlike stocks or businesses that feels risky. But the truth is, if you don't understand how the numbers work, property can become your biggest trap. Many investors don't realize how much they're spending. Repairs, interests, management fees, land taxes, council rates, it all adds up. Meanwhile, your cash flow dries up. You can't invest in other opportunities because your money is stuck in a loss-making asset. And what's worse, if the market drops, you still owe the bank the same amount of money. And here's something that nobody talks about. What if you lose your primary source of income, which in this case, or most of the times, is your employment? Then what happens to your investment property? So what should you do instead? Number one is build strong cash flow. Start with side hustles, stocks, or index funds to increase your income. Number two, only buy a property when you can hold it stress-free for over 10 plus years. Number three is make sure that it pays for itself or at least breaks even. Number four is focus on long-term growth, not short-term tax tricks. Because the real winners in property are not the ones who's chasing tax deductions. They're the ones who own profitable assets that generates incomes monthly. So, the next time that someone tells you, buy a property, it's the best investment out there, ask yourself, is it actually an investment or a monthly liability? Remember, the rich don't play the same game as us. They buy property when they already have a cash flow. They use it to protect wealth, not to create.
Buy apartment houses. I only own apartment houses. I want somebody else to pay my mortgage for me. If I own my house, I'm the tenant.
Right.
I don't want to be my own tenant.
But in this environment where everything is crashing, is buying real estate now a good time?
Well, you got to be smart, and real estate is just as tough, but you got to be smarter. So that's why I always say your greatest asset is not this or this. Your greatest asset is between this year and this year.
So, before you jump into a negatively geared property, thinking it will make you rich, build your foundation first. Invest in yourself, your skills, your income, and your mindset. Then, when you're ready, you'll buy property the way the rich do, with actual cash flow and not with hope. If you find this video helpful, please like and subscribe and comment cash flow first below so that we can continue making these videos. And as always, see you next time.